Hey, how's it going, guys? Yes, it's official. We're officially in the middle of an inflationary market, or even a potential inflation crisis. The CPI data just came out last week, 4.2% implied inflation rate year over year. This is more than doubled of what the Federal Reserve's 2% annual target rate. The market had a pretty big sell-off in the middle of the last week as investors were expecting the Federal Reserve might raise the interest rate, which is very bad for stocks. And then the market quickly bounced back up. Although we're still in the bull market, we should expect the market will stay choppy for a while before it fully prices in all the inflation worries. And such market environment can give us some great buying opportunities in the market. So in this quick video, I will quickly share with you guys one simple technique I'm currently using to help me find those good buying opportunities and take advantages of every time when there's a market sell-off. Alright, let's get started. If you ask a retail investor what is their favorite stock index to watch on a daily basis, they will probably tell you S&P 500 or Nasdaq. But if you ask hedge fund managers or institutional investors their favorite index, they will definitely tell you it's the VIX or the Volatility Index. Yes, the Volatility Index can give us a lot of valuable information, especially the information on which direction the market is potentially heading into over the short term. Some people call VIX the Fear Index because whenever there's a panic market sell-off, the VIX always goes up. In fact, because of this perfect negative correlation, long volatility has been one of the most effective ways to hedge your portfolio against a major market crash. I made a video a while ago to show you guys exactly how such hedging strategy works. I will put the link in the comment section below if you want to check it out. But apart from being a fear index, we also consider VIX is a smart money index. Because if you know how to use it, it can actually tell you exactly when the smart money comes into the market and buy those dips at a cheaper price. That's why in this quick video, I will show you guys exactly how you can do it by yourself, and it's super easy. Here's how it works. This is the chart of the VIX index from 1991 all the way to 2021, 30 years in total. Over the past 30 years, the average value of the VIX is 19.5. This is the place or the range where the market moves at a very stable pace. It's also considered one of the most important signs for a healthy bull market. If we do the normal distribution of VIX value over the past 30 years, we can get the sigma, or each value of a standard deviation of VIX, is 8.1. So with this sigma value, we can calculate the value of VIX at a 1 standard deviation is 27.6, and the value of VIX at a 2 standard deviation is 35.7. If you don't understand the basics of statistic or the probability normal distribution, it's completely fine. You don't need to understand all this math. All you need to know is that these two levels are exactly the places where those smart money institutional fund managers are watching and are ready to buy. And because of the capital size usually much larger than the retail crowds, their buying activities will push the market going up. And we, as retail investors, all we need to do is to wait at those two VIX index levels and follow the institutional money when they start buying the dips. With the help of institutional money buying the dips with you together, you can dramatically increase your success chances and reduce your risk. Let me use one example to show you exactly what I mean. Let's come back to the VIX chart and zoom into this year 2021. So this is how the volatility moves over the couple of months. If we add the 1 standard deviation and the 2 standard deviation levels we just calculated earlier into this chart, we can see that these two lines perfectly form two layers of clear resistance levels for the VIX. So what kind of information we can get from this chart? How can we use it to navigate the market? Well, first of all, as we already know, the historical average level of VIX is around 19.5. So roughly, whenever the VIX within this range, it means the market is in a healthy, stable environment moving up. Whenever there's a minor pullback in the market, which is a pretty normal thing, the VIX will hit the 1 standard deviation level and find a resistance. If the pullback turns out to be a deeper correction in a much shorter period of time, the VIX will break the first resistance level, straight away go up and test the 2 standard deviation level and try to find a new resistance over there. And this chart shows this perfectly. Over this period of 6 months, there were 4 times the VIX hit the 1 standard deviation level and it came back down to the normal range. And actually for once, the VIX actually hit the 2 standard deviation level, find a resistance over there and came back down to the normal range. And guys, here is the key message. Whenever the VIX hits these two levels, it can give us great buying the dip opportunities because these are exactly the places where the smart money will most likely come in and start buying. Let's combine the VIX chart with S&P 500 together and you will know how powerful it is. So as we can see, every time when there's a pullback, VIX will either hit the 1 standard deviation, which is 27 to 28 level, or the 2 standard deviation, which is 35 to 36 level, and find a clear resistance at these two levels. When VIX finds a clear resistance and then retraces back lower to the normal range, it is a very strong sign that the market has found the buyers, and this is exactly the buying signal that we're looking for. So if we buy the S&P 500 right after VIX hit these two levels, we would catch the bottom every single time and accumulate a pretty good return over this period of 6 months. Especially in the most recent sell-off after the new inflation data came out, the market has reacted pretty negatively, dropping almost 5% in just 2-3 days. The VIX hit the 27-28 level and immediately retraced back. If you know how to use this smart money index, you would have successfully bought a dip on Wednesday, added more positions at a much cheaper price, and then enjoyed the way up the next couple of trading days. Alright, there's one extremely important thing I need to highlight about this smart money index is that it only works well when the VIX is below the 2 standard deviation level. If the volatility breaks the 2 standard deviation level and stays above it, or even goes higher and hits the 3 or 4 standard deviation levels, that is the scenario of a serious market crash, like what we saw back in March last year in 2020. When the market crashes into a bear market, there will be different ways and strategies to detect those potential institutional buying activities. I will share with you guys some of those strategies and techniques that work very well for those big crashes in the future videos. The technique I share with you in this video works the best for those normal corrections in a long-term bull market or choppy ranging market, just like what we're heading into in this inflationary market environment. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market. And I also share some educational contents to help your investing journey just like this one. If you are interested in the world of finance and business and find my videos being valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I will see you guys soon.